Financials up about 1% today, but as we were just saying, banks have been battered by weeks of losses. They're the worst performing group in the S&P this year. Well, our guest says these stocks look cheap. He's Chris Kotowski, analyst at Oppenheimer Co. He's a Bloomberg best, meaning, Chris, you're right on the money when it comes to predicting how much money these banks are going to make. So is there any reason, or I should say, what is the reason at this point to get excited about the banks?
Well, I think you put four facts together. One, the stocks are incredibly cheap. Two, credit quality is getting a lot better fast. Three, loan volumes, which had been declining all through the last 2 years, have bottomed, seem to be flattening out, and are poised for growth. And then fourth, I think ultimately all this regulatory uncertainty is not going to be as big an event as the market fears, because in my view, regulatory burden is a cost of doing business. It hits all banks equally. It's kind of like the cotton in a shirt. It's going to hit all the shirt manufacturers equally.
Well, Chris, that may be the case, but the market is still effectively saying, no, we're not buying it. I mean, that's why they're down. So what's going to turn around the view on the banks and get people to sign on to what you're saying?
Well, let's look at, if you look at the trading pattern, not just year to date, but look at it since the bottom in March of 2009, we've had 4 major periods of massive outperformance by bank stocks and 4 major periods of massive underperformance. So you mentioned how they're down year to date. Well, what you didn't mention is that between Thanksgiving and New Year's, for some peculiar reason, bank stocks outperformed by 1,000 basis points. And so you have this weird macro dynamic now where people are trading these stocks based on macro data points. What's the unemployment doing? What's happening in Greece? And they're not really looking at the fundamentals of the banks, which are broadly improving.
Chris, I want to ask you about improving credit quality. You mentioned that as one reason to be bullish on banks, or at least optimistic about it. With this evidence that we are in a soft patch of the economy, and you mentioned how loan volumes continue to flatten out, they're not getting better, won't credit quality be possibly a concern again?
Well, I think loan volumes are getting better. Okay, I mean, you're going from a negative to flat, and it's always the trend that matters more than the absolute magnitude, in my view. In terms of the asset quality trends, I think they are so well embedded. You look at the early delinquency trends in the credit card master trust data, which we get on a monthly basis, came out yesterday. They're at all-time lows. And the thing is, credit quality for banks is more than a function of just where the economy is. It's also a function of whether you've been making a lot of loans. If you've been making a ton of loans over the last 2 years, chances are some good percentage of them are going to go bad. If you haven't been making a lot of new loans, you're going to have better credit quality than you expect. And just at a conference a week or two ago, one of the CEOs of one of the major banks said credit quality is going to get too good for all of you. And what he meant is that since we haven't been making loans, the revenue side is going to be sluggish, but the asset quality side is going to be great.
All right, Chris, let's talk about some of your picks. You like the big guys, Citi, for example, Bank of America, JP. Explain the reasoning there and why you like the big guys rather than the smaller banks.
Oh, valuation overwhelmingly. I mean, for one thing, there's this thought that there's a problem with big banks, that big banks are too big to fail. The actual fact is, over time, big banks are more stable, more sound, more diversified than small banks. That's point number one. Point number two is that the stocks are just incredibly cheap. You look at Citibank now, it's trading at $37, $38. Tangible book value, what you could theoretically liquidate the company for, is $47. And unlike in 07 and 08, tangible book is going up, not down. And I think it's just an incredible valuation, and people are slow to turn around to catch the change. If you go back to 2008, you had 3 consecutive quarters where Citi was losing money,
right,
and the stocks was still trading up north of 2 times tangible book.
Right.
Now you've had 5 quarters of profits, and it's trading below book.
All right. Thank you so much, Chris Kotowski. Believes bank stocks are cheap, and it may be time to get in.